Right, time to bring in Dr. Stephen Nash from FIIG Securities, get a bit of a look ahead to what to expect from the London session, as well as a couple of issues dominating our market today. Good afternoon, Stephen.
Hi.
Let's kick off with the Chinese PMI number, the HSBC flash PMI number, I should say. Good reaction, particularly in currencies. Understandably overdone on this particular amount of data, or should we be swinging from the rooftops in regard to the strong read?
Look, I think it's way too early to get too excited about Chinese growth. Obviously, the targets between 7 and 8% look achievable at this point. We get a lot of volatility in these readings. I don't think we should be making too much of this at the moment, although it appears that the influence on the Aussie is there, with that making the likelihood of a rate cut a little bit lower. But as this Aussie goes up and up, the pressure on the RBA also increases. As we know on the easing side, we're getting towards quite elevated levels here. I can't really see much to stop this. So I think the real influence here is that weaker US dollar, and I think that's going to continue.
So where does that leave the RBA? If there's not going to be, is there going to be much data, particularly domestic data, between now and the next RBA meeting? It's not really very far away at all. It's over a week away to see some of the steam come out of the dollar.
Look, I can't really see much action from the RBA at this point. They've put a lot in the system. They've really tried to stimulate as much as they can. From a regulatory point of view, from a lot of different perspectives, I really can't see much of an argument to just continue to ease without a pause and an evaluation period starting. And I think that's what we're starting to see with the really quite systematic change in the language from the RBA in the last 3 minutes that they've put out. So I think the idea of really getting carried away with easing talk at the moment, it's a bit optimistic, I think, in our view, and I think that easing talk will continue, but it's really an issue for 2014.
So you don't think they cut in October or November in order to get the Aussie dollar lower?
Look, I think cutting just on the basis of the Aussie dollar is probably, again, a little bit optimistic, because a lot of the easings really haven't had much effect on the currency anyway. As we eased and eased and eased, the Aussie went up and up and up. So it really depends on what's going on in the US dollar, and there, I think those more moderate comments from the Fed and the idea that we could have a political stalemate emerging this week in the US, will see that dollar, I think the US dollar a little bit weaker and Aussie a little bit stronger.
Do you also see the RBA factoring in concerns around the housing market? I mean, we just saw in the story before coming to you about banks reportedly increasing their buffer in regards to lending, all on the back of concerns over house price rises. Is that something that will be discussed at board level?
Yeah, look, I think this is part of the evaluation procedure that the RBA goes through to ensure that house prices are not getting out of control. To call the market at the moment it being in a boom is probably a little overstating it a little bit. I think we've had some firmness in house prices. There's a wealth effect from that. And I think that's where the RBA are hoping that...
Do we talk ourselves into a boom, though, as well, do you think? Is it almost a self-fulfilling prophecy? The more we talk about housing bubbles, booms, house prices, it almost creates the euphoria and activity around it?
Very much so. And, the discussion so far has been quite hysterical in my view, and really, people really getting carried away with that term very quickly. There is some firmness out there in terms of property. That's great to see. I think we're a long way from a full-on housing boom. I think these comments from the banks are good, are positive. The banks are going to be responsible. We expect that they would be. It's in their own interest to be responsible. The real problem, I think, for the housing market is unemployment. Now, that's why rates are as low as they are. I mean, if rates were higher, say 2% higher than they are now, you can imagine what that would mean for unemployment. Unemployment is the real problem for the housing market. If we get elevated unemployment towards 7-8% level, then we've got a problem with the property market, but not yet.
But I mean, is anyone actually factoring those sorts of levels in?
No, not at this point. But for those saying that rates are already too low, I think that's something to consider, because rates are here in order to I think stimulate growth, but also control that rate of unemployment from getting too high. And we've seen some moderation. There's good prospects for some moderation in 2014, but we're still talking unemployment to go over 6.25 by the end of 2014.
The recent China data, picking up from where we started in regards to the flash HSBC flash PMI, does it do some of the work that the RBA would look to do through lowering rates, the positive sentiments and growth coming out of China and the flow-on effects to our own economy and confidence?
Yeah, to some extent, this is a positive for Australian growth. I suppose that dire prospects for the mining industry mightn't be as dire as everyone's expecting, that we will get a deceleration in mining but not a complete collapse. And some firming of the mining sector combined with a mining sector that's not collapsing is, when you weigh it all up, quite good news for the Australian economy. But I think this week, is really all about the political system in the US and what's happened with the recent bill that's been put to the Senate, which we imagine will be rejected or at least amended substantially. And I think the US Congress is running out of time here. They've only got a few more days left.
This is the debt ceiling, yeah?
These are the appropriation bills for the government spending, and it appears it's going to go down to the wire here. And I think by Friday the market will be quite concerned about this eventuality.
Do you think the market is going to think to himself, I've seen this before. I've seen this movie. I didn't like it the first time. I know how it's going to play out. It goes down to the wire, then they pass it.
I'm not sure. Look, I would have thought that they wouldn't go to a shutdown, but I think just given the lack of time that we've got here and the degree of disagreement between the parties, it does look as though it's more a possibility than I would have thought even a week ago. However, even if they do get the appropriation bills through, and it is acrimonious as I expect it will be, that sets up the debt ceiling debate for later in October. So it really doesn't matter what happens. There's still going to be a lot of denting of growth expectations, I think, as a result of these discussions that are going on this week in the US Congress.
All right, on that note, got to leave it there. Dr. Stephen Nash, thank you very much.